Japan's recent currency intervention on July 12, 2024, with an estimated 3.5 trillion yen, $22 billion, to support the struggling yen, marks the third such intervention by Japanese authorities in 2024. This move highlights the ongoing challenges faced by the world's third-largest economy in managing its currency amidst global economic pressures. The Japanese yen has been on a downward trajectory since early 2021, losing over one-third of its value against the US dollar in the past 3 years. This decline reached a critical point when the yen hit 160.17 against the dollar on July 11, 2024, its weakest level since April 1990. The currency's persistent weakness has become a significant concern for Japanese policymakers and has far-reaching implications for the country's economy. Several factors have contributed to the yen's decline. The primary driver is the substantial gap between interest rates in Japan and the United States. While the U.S. Federal Reserve's benchmark interest rate stands at 5.25%, the Bank of Japan, BOJ, maintains a near-zero rate policy, with its benchmark rate at 0.1%. Japan has maintained an ultra-loose monetary policy in an attempt to stimulate its economy and escape decades of deflation, in contrast to the U.S. Federal Reserve's tightening cycle to combat inflation. The significant interest rate differential has made the yen a popular funding currency for carry trades, where investors borrow yen at low rates to invest in higher-yielding assets elsewhere, putting further pressure on the Japanese currency. Additionally, Japan's prolonged economic stagnation, often referred to as the lost decades, has contributed to the yen's weakness, as the country has struggled to achieve sustained price and wage increases. The July 12 intervention came in response to a sudden 3% surge in the yen against the dollar, triggered by unexpectedly soft US inflation data. While Japanese officials did not explicitly confirm the intervention, Bank of Japan data strongly suggests it took place. This intervention highlights several key points. The yen's sharp movements, both up and down, underscore the currency's vulnerability to external factors and speculative trading. Japanese authorities have expressed deep concern about the effect of rapid, one-sided currency moves on the economy, with Finance Minister Shunichi Suzuki emphasizing the desire for stable exchange rates. With the interest rate gap between Japan and the US expected to persist, currency intervention remains one of the few tools available to Japanese authorities to influence the yen's value, and the long-term effectiveness of such interventions remains a topic of debate among market observers, as previous interventions, including a 62 billion effort in 2020, One of the significant challenges facing Japanese policymakers is the popularity of the yen carry trade. This strategy, which involves borrowing yen at low interest rates to invest in higher-yielding assets elsewhere, has become increasingly attractive as the yen weakens and interest rate differentials widen. The carry trade creates a self-reinforcing cycle. Investors borrow yen and sell it to buy higher-yielding currencies. This selling pressure weakens the yen further. A weaker yen increases the profitability of existing carry trades, attracting more investors, and the cycle continues, putting persistent downward pressure on the yen. The total return on yen carry trades has reached an impressive 18% over the past year, making it one of the most lucrative bets in foreign exchange. This popularity may limit the effectiveness of BOJ rate hikes in strengthening the yen, as long as significant interest rate differentials persist. The yen's weakness has both positive and negative effects on Japan's economy. On the positive side, it boosts exporters' profits by making Japanese products cheaper for foreign buyers and encourages inbound tourism, with record numbers of foreign tourists supporting local businesses. However, the negative effects include increased costs of imports, particularly food and fuel, putting pressure on household budgets, creating uncertainty for businesses engaged in international trade, and potentially eroding confidence in the Japanese economy among international investors. The Federal Reserve's monetary policy decisions have a significant impact on the yen's value. Recent indications from the Fed have dampened expectations of significant interest rate cuts in 2024 due to persistently high inflation. This outlook continues to support the dollar's strength against the yen. The higher for longer interest rate environment in the US creates a challenging scenario for Japanese policymakers. As one analyst bluntly put it, the grim reality is that the yen's slide won't stop until the Federal Reserve relents on its higher for longer policy path. As Japan grapples with its currency challenges, several factors will be crucial in determining the yen's future trajectory. The BOJ's monetary policy will play a key role, and while the bank has signaled potential interest rate hikes, any increases are likely to be modest and may not significantly narrow the interest rate gap with the US. Changes in global economic conditions, particularly in the US, could alter the dynamics affecting the yen, with a shift towards monetary easing in the US potentially providing relief for the Japanese currency. Long-term strengthening of the yen may require addressing fundamental economic issues in Japan, including stimulating domestic demand and increasing productivity. Some analysts suggest that coordinated action with other central banks might be necessary to effectively influence currency markets. The Japanese authorities face a delicate balancing act. While they aim to support the yen and maintain price stability, they must also be cautious not to hinder economic growth or disrupt financial markets excessively. Japan's recent currency intervention underscores the complex challenges facing policymakers in an interconnected global economy. While such interventions can provide short-term support for the yen, addressing the underlying factors driving its weakness, including interest rate differentials, economic stagnation, and the allure of carry trades, will be crucial for long-term currency stability. As global economic conditions continue to evolve, the fate of the yen will remain a key focus for both Japanese policymakers and international investors alike. If you liked this video or want to know more, please consider liking, subscribing, or leaving a comment on what you'd like me to change or to know more about.